Good morning, everybody. Uneducated Economist here. So in this video, I want to talk about this speech that Christopher Waller had given July 17th, 2025, the case for cutting now. He actually uses the term flashing red when it talks about the unemployment numbers. It goes like this: there is another reason to cite the slowdown in private sector hiring. A pattern in data revisions in recent years tells us that the private payroll data are being overestimated and will be revised down significantly when the benchmark revision occurs in early 2026. So he's admitting it right there, that the unemployment numbers or the private payroll numbers are not accurate, that the data in recent years has told them that the payroll data is being overestimated, and that they are very well aware of this overestimated payroll data and that it will be revised down in early 2026. He goes on to say this: accounting for the anticipated revision to the level of employment in March of 2025 and extrapolating forward, private sector employment gains last month were much closer to zero. This is right. This is them admitting that the numbers are fake. They know it. They know they're not right, that they are going to be revised down, and that the issues that we are facing are much more dangerous than anybody had ever realized. He goes on to say this: this is why I say private sector payroll gains are near stall speed and flashing red. Right? See, as everybody kind of talks about how the economy is resilient, the labor market seems to be resilient, although it's weakening, he's saying that it's far worse than even the data is showing, and that it's going to be revised down in early 2026, and that they should act preemptively. This is one of the reasons why he is calling for the case for cutting now. Understanding that the Federal Reserve is attempting to get the Fed funds rate, which is their short-term overnight lending rate between the big banks that they tried to target, they are attempting to get that Fed funds rate to neutral, which is a very difficult thing to wrap your head around, considering that most people are not aware of what a neutral interest rate is. The neutral interest rate is the rate when the Federal Reserve has the Fed funds rate that is neither accommodating nor restricting the economy. It's neutral. The funny part about the neutral interest rate is that it will rise and fall on inflation expectations. So if you raise the inflation expectation, you will raise the neutral interest rate. If the Fed funds rate is now elevated, but it is getting closer to the neutral interest rate, cutting rates may land the Fed at neutral, and it could cause the Federal Reserve to actually become accommodating as the neutral interest rate continues to rise on the elevated inflation expectations due to the threat of tariffs and the uncertainty within the economy. So this battle between the two, should they cut the Fed funds rate to get to neutral, or will neutral interest rate find the Fed? Uneducated Economist. You guys let me know.